Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, November 15th, 5:55 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in a bear market rally. NASDAQ 100 and S&P 500 still cannot get it back above the 200-day moving average, while the other three indexes have. You can see over here on the trend gauge, market leaders continue to act bullish slash uptrend. Good leadership, good. In fact, I have a second 21 over 21 that I'm monitoring for stocks trying to break it into the primary 21 over 21. As far as the short and medium term trend goes for the five major indexes, all trending above those moving averages, that being the short term 21, the medium term 50-day. As I mentioned, long term, the big two indexes that make up most of the weight that goes into these arrows still can't get back above the 200-day moving average. Haven't challenged them. In fact, came within 1% today on the S&P 500, and the NASDAQ 100 has been playing some catch up over the last couple of days, but still not quite there. So showing bearish slash downtrend for the long term. As far as what happened today, really busy, eventful day. So 8:30 a.m. Eastern Time, PPI came out. This is a gauge of producer inflation, and the question is if producer inflation persists, does it trickle to the consumer? But good news across the board on PPI data. Every metric was lower than expected, and that resulted in a big 1.7% gap up on the S&P, 2.6% on the NASDAQ 100, but that's as far as we went. We then went into a tight chop, 0.5% range sideways until a little while after 1 o'clock Eastern Time, some news came out that some missiles had hit a grain silo in Poland, and the market sold off sharply. And then, of course, you get conflicting stories. Russia says it wasn't ours. Other people claim that they were not actually Russian missiles. It was debris from a missile defense system from Ukraine that ended up in Poland. And then government sessions held in Poland with NATO to see if they want to invoke any of the articles of protection. And what it amounted to was a break of this key fib that we've been watching. It's the 4007 level on the S&P, and it represents a big fib level, 61.8% retracement of the recent leg down. We got above it. Actually, we tested it yesterday and failed. Today we gapped above it. It was acting as support on all the pullbacks until this news came out, and then we had a big move down off of that. And then we tried to recover, and it acted as resistance late afternoon as part of the recovery. So that fib failed again, but we did finish well off the lows and firmly green for the day. And growth outperformed value, which is certainly another plus. G6 up 1.82%. S&P, as I said, gapped up 1.7%, was actually red for a while after that news reversal after 1 o'clock Eastern Time, but recovered to finish up 0.87%. NASDAQ 100 up 1.4%. Dow was the laggard all day, up 0.2%. Mid-caps up 1.6%. Russell 2000 up 1.5%. Global diversified 60/40 stock and bond up 0.84. Got some help from bonds as interest rates pulled back on that CPI data news. GROTECTION in-house up 0.37%. Combination of yesterday and today still has us ahead of 60/40 and the S&P 500, but we did get some stops triggered on that harsh pullback today, and I'll go over that when I review the portfolio. So now, and then we'll do the tail of the tape and charts of interest, but now an explanation on what we do quickly here at Revere for anybody that might be new to following us. Revere is an SEC registered investment advisor, fee-based only, fully transparent, conflict-free. We're a fiduciary, which means we always have to act in the best interest of our clients. Our flagship portfolio is called GROTECTION. It's designed to participate in market uptrends and protect client funds in market downtrends. And there are a lot of gray areas between fully invested and not invested, and that depends on the slopes of the lines and where the moving averages are and how leading stocks are acting. For example, fully participating in the market example is last October, November. We're trending nicely above all three of the moving averages. We start to go sideways. Some of our stops will get hit. We'll lighten up a little bit. If we start to pull back more, you'll see the slopes of the lines on the short term and medium term start to roll over, and we'll get increasingly more defensive. And then in a worst case scenario, we break below this black line. That's the 200-day moving average. And we get in a maximum defensive posture at that point. And the reason for that is this chart, which is a breakdown of the last 13 bear markets. Some of them can be extremely severe. Those are the ones that are shaded on average, down 44.5%. You need an 80% return to get back to even if you get hit with that, and you have the same amount of risk as the S&P 500. That's why our first job at Revere is to protect our client assets. If you protect the drawdowns, the returns will take care of themselves when the market goes back to a healthy posture. And we've got several rules for re-entering the market, such as false breakdowns, moves back above the shorter and medium term averages, and that's where we've been since this false breakdown on 10/13. We've been participating in this uptrend. We're coming now into this key declining black line, the 200-day moving average, where we failed previously at the beginning of August on the prior rally off the lows. And there's a key area here, this 4,007, that we failed at twice over the last 2 days. So that's definitely something that we're watching. And if you're interested in an approach like this that proves that you don't have to be a slave to the ups and downs of the market, you don't have to be at their mercy, we can actively manage around it, give us a shout. My email is don@revereasset.com. Partner and Revere President Dan Stewart can be reached at dan@revereasset.com, or you can call 855-REAL-WEALTH. That's 855-732-5932. All severe bear markets have taken place below this declining black line, and that's why we minimize or we limit our the amount that we're willing to put into the market as long as we're below this black line. So let's bring up the tail of the tape. Nope. Let's first bring up these other indexes that are a key to what we're watching, and let's start off with the VIX. Big spike on the VIX today. You can see this coincided with the news about that missile hitting Poland. Let's bring up a 5-minute chart here. You think you can tell where that news came out, but yeah, pulled mostly back by the end of the day, still holding above this 24 level. Ideally, we'd like to see it below 24, but this is nicely acting inverse to what's going on in the markets. On the S&P 500, we broke that 4,007 level. Let me bring up a 5-minute chart here, and you can see 4,007 undercut, but held repeatedly all throughout the morning until this big breakdown, and then you can see the recovery back to highs. The 150-day moving average was on here. The lows of the prior 3 days have also represented where the 150-day moving average is. That's the Stan Weinstein line that he uses, that and or the 30-week moving average as that's his dividing line between a healthy and an unhealthy trend. NASDAQ 100. You can see higher high today relative to the last 3 days with relative strength continuing. NASDAQ 100 tends to lead uptrends and lag in downtrends, although it hadn't been leading this most recent leg up. That was the Dow that's been leading, but that has flipped over the last couple of days. You can see the relative strength coming off ever since that PPI or that CPI report last week, and then follow it up with the PPI report today. The Dow just really consolidating over the last 4 days, not making much progress. How about mid caps? Higher highs, and also small caps above the 200, below the 200, back above the 200. We added to our small cap when we recovered this morning on the nice early action. We'll talk about our trades when I go to the tail of the tape. So we showed the VIX. Also, what did gold do? Dollar was down today. Gold was up. That inverse relationship continues. Here's the UUP actually consolidating. Briefly dipped to make a lower low, rallied a little bit when that news came out. So within a 3-day consolidation, very similar to the S&P 500 and what it's been doing. Bitcoin, little bit of a bounce today, not recovering, and this FTX, there's another exchange has filed for bankruptcy on the fallout from FTX, another crypto exchange. Let's look at TLT. Up higher today, which means yields were lower. 0TYX is the 30-year. Still above the 50. 21-day is rolling over. This is good for stocks. Let's look at the 10-year. This is actually broke below the 50-day moving average today. And again, the 21 rolled over, and that also is good for stocks. I said I was going to start monitoring junk bonds. I guess they're acting pretty well, actually up more than the market was today. Great earnings before the market by Walmart. Gave the market a jump to the upside before the PPI data even came out, and retailers of all sorts had a great day today. Now, last time Walmart gapped up on its earnings report, that put in the top within 2 days. The market started another leg down. We'll see what happens now, but this was at the end of that most recent rally up into the beginning of August. We've been rallying up again over since that August 13th shakeout, October 13th shakeout. So we'll see what comes from there. So those are all the key indexes that we want to look at. Let's get into the tail of the tape and then some individual stock charts now. Put call, second out of 3 days that it's been really low. In fact, it didn't spike much at all during that missile news, that Poland missile news. So we don't want to get too complacent on the put call. If it gets too low, usually you get a rug pull after that. VIX did, as I said, spike up a little bit. It got as high as 26.22 on the day, closing at 24.54, still up 3.4%. Fear and greed ticked up 3, still operating, of course, under the rally and reclaim of the 21. So that's our bull case. Technically, multiple indicators are acting as a tailwind for the market. I talked about the PPI news, the missile news, the day count. 2 consolidation days after 2 up days as we made a higher high but can't stay above that key 4,007 level. Lithium companies were absolutely hit hard today, less than 10%, but high single digits on multiples, as several of the big brokerage houses, Credit Suisse, Morgan Stanley, and Goldman Sachs, all came out warning about falling lithium prices. The semiconductors got a bump from Warren Buffett taking a sizable stake in Taiwan Semiconductor. So he's not only not worried about China attacking Taiwan, he's also apparently not worried about the recent weakness in semiconductors, but he does tend to buy low and then sell high. Expectations coming in today positive as long as we stay above that 3,900 area. Had our gap up, we chopped, we faded, we recovered. The fib area and or the resistance area here, 4,007 and 290, got above it but failed in both cases. You can see the ranges throughout the day today. Outperformance today from retail, as I said, semiconductor, software, ITB, which is home builders, ITA, aerospace and defense on that missile news. Oil started weak. They were strengthening before that news even came out. We took a position in an energy ETF, my favorite energy ETF on that, 1.5%. It's a 2 times. I like the diversification in there. It's not all producers. It's not all services. It's not all the big Exxon and Chevron. It's got some good diversification. Dollar down, lithium down, gold stocks, were they down? They were down, yes. Silver down, gold up slightly. Biotech, the small cap biotech, negative on the day, as well as XLB, that's basic materials, and XLV is healthcare. We'll go through the focus list. I mentioned we added to UWM, bought that energy ETF. Let's take a look at this. We sold it into strength after this long run up. It had a little bit of a harsh pullback and bounced. Third day consolidating. We took a position. We're up slightly on that. Also, I was looking very hard at Boeing and considering purchasing it after this little 4-day flag that it's putting in and at the top of the range. And then anytime I consider buying a big stock like this, I ask myself, is it possible that it could outperform the S&P 500 by at least a factor of 2? And looking back at this 2016, or actually early 2017, all throughout 2017 through January of 2018 before it started consolidating it, Boeing was up 125% while the S&P 500 was up only 25%. So if fund managers decide to put money into Boeing, it absolutely can outperform the S&P 500 by a significant measure. And this is what it looks like has been happening since they mentioned that they'd be cash flow positive next year. Nice recovery after a negative reversal on their earnings report, which put in the recent low, and now a flag. This is the flag that I've been looking for, so this is very high on our buy list. But when that missile news came out, we bought LMT as that LMT and all of the defense stocks spiked. At the time, I liked how LMT undercut, then recovered that 21. This had been on our 21-21 list for a while. It came off last week due to relative lack of relative strength. But again, enough of a pullback and a recovery of the 21 today. And if this ends up being nothing, we'll be stopped out for a very small loss. So added energy, added LMT. When we broke back through that fib on the S&P 500, we got rid of our SSO position. When we broke back below that fib that we've been tracking on the NASDAQ 100, this 286.82 level, we sold our QLD for a small gain, both of those for gains. Still holding our small cap long, and we've got 5 stocks now that we're long, plus the energy ETF. Let's see, here's the focus list, and overall our exposure dropped from 0.7 to 0.63. Market that we're in right now, which is below the 200 but above the 50 and the 21, we want to have a minimum exposure of 0.6 and a maximum of about 1.0. That's give or take a little bit, but that's basically the range we want to stick in until we get back above the 200-day moving average and the slopes of the lines get properly configured. So we're still in 0.63, so 63% of the equivalent risk of the S&P 500. Less exposure to the indices than normal. It's more in stocks now, with the exception of the small cap index, but we'll let if we can get a lower risk entry on pullbacks to the moving average, because the S&P was extended 4.5% above its 21-day moving average, which is a little bit excessive. Would like that to catch up, at least the 8 to catch up. So it's really not a surprise that we're failing at this 4,007, and we're just taking some money off on strength that flashes weakness, if that makes any sense. Want to lock in the gains that we're having and look for lower risk entries, preferably a pullback, or if we break strongly above the 200-day moving average, that would indicate another leg up, and there'll be plenty of time to make money if the market is going to trend higher. above the key long-term moving average. There are a lot of algorithms, a lot of money managers that limit their exposure as long as the S&P is below the 200-day moving average. So bottom line, big gap up on the PPI data fades. The news broke us back below that key fib, but we did bounce into the day. A lot going on today. This 4,007 now has been key resistance for 2 days. On the downside, this 150-day moving average has been support for 2 days. So between 39 to 60-ish. If you want to go with the 30-week, it's 39.37, and 4,007. We're battling back and forth in this range, and we'll see which range wins. Let's look at a little bit of a longer time frame here. Here is the 60-minute chart. You can see the big move up, the gap up that failed today. If you look at a 15-minute chart, you can see really just chopping. It's 39.50 on the downside. And on the upside, really mostly 4,010 with spent a couple of hours above there, this 4029 level today with today's high. And then, of course, we've got the declining 200-day moving average, still losing about 2 to 3 points a day. And we're 2% away from that now. We got within about 1% of it at today's high. So let's go to some individual charts. We'll do the focus list. We'll talk about why we're looking at it and what we're looking at while we're there. GFS was itching all day to add to this, ended up not doing it. It broke out above this flat base, but really no handle. I'm not going to buy something that's gone straight up. I've got the position. It's a leader. The volume is perfect, but every time I've chased in these bear market rallies, I've ended up getting bit by a harsh pullback and just not really in the mood for that. So we'll hold on to the 2% that we have and look for a better risk reward to add to it. Really like it a lot. A new solar stock came out kind of from nowhere today. Shoals Tech Group, huge gap up on earnings, 538% volume, up 22% on the day. Broke out of this flat base, but pulled back. Really, it started to pull back before that news came out and didn't quite make the recovery. If we look at a 15-minute chart here, you can see up, pull back, didn't get back up to the highs, kind of similar to what went on with the S&P itself. But note, oversold here now on a 15-minute stochastic. Might get an opportunity to get into this. And again, big gaps on earnings like this should not break more than 1 to 2% below the low of the gap up day, which is 25.79. It's at 27.40. So decent low risk here. We know that solar is absolutely an A-plus rated group. We still own First Solar, which closed strongly today, went into the top of its range. But notice anytime it's got into this 160-ish area, it's pulled back over the last couple of days. Maybe it's just time for some fresh merchandise in the solar area. Array had its gap up and has held it and made a higher high today before pulling back. And Enphase has just really been an ugly chop fest over the last couple of weeks since its earnings gap up. So a couple of other solar stocks acting pretty well, but definitely want to put SHLS on the watch closely list. So next up is Wing. Continue to watch this. It's consolidating. I really want to see a pullback at least to the 8 to get involved with this, and preferably closer to the 5%, the pivot plus 5%. Again, just not something I want to chase. Celsius continues to hold up well after reversing on its earnings day, closing at the top of the range today and up near this 100 area where it faded on the gap up day. So maybe everybody that wanted to sell Celsius, this was an inflection point day, and the low of that day has held. Now we come into the top of the range. This keeps looking better if it keeps going sideways for a little bit. It did hold the 21 on the pullback back above the 50-day. Celsius looking better as the week goes along. AEHR really looking like it wants to be an absolute leader with this 4 days, 4 higher high days after coinciding really with the CPI day on the 10th, and just absolutely reclaimed its leadership. You can see the volume, above average volume there. Need to find a way to sneak into that. BIIB and really the big cap biotechs continue to act well. Here's XBI. There's an entry point somewhere in here for these. I like how this is consolidating for 2 straight days. This is the smaller cap biotech. Tried to poke its head out each of the last 3 days above this 85 level, but can't quite do it. And then IBB, which continues to act fine, making higher highs over the last 4 days. Big cap biotech definitely seeing some money flows into it, as that's a growth alternative if tech continues to disappoint. You see from time to time that money flows into biotech instead. ON has made a great comeback since its earnings negative move down and big move up on CPI day, consolidating near the top of its range. Haven't missed anything with this one. It's just at the top of the range. Want to see it handle out a little bit more. I already showed the Walmart chart. Home Depot reported earnings and initially gap was down about 2%, ended up 1.6%. There's another one that is consolidating above the 200-day moving average. So again, the question is, can this significantly outperform the S&P 500 while it's in a strong uptrend? And you can very much see that relative strength increasing here while the price action is increasing. So short answer is yes, and we know that it outperformed strongly during COVID, outperformed the S&P 500. This was a big move up here before putting in this exceedingly long base. But I've done a lot of reading, and if people with low rate mortgages can't sell their homes or don't want to sell their homes because they can't get into a new house, they're going to put money into their existing home, and that's right up Home Depot's alley. So we may be putting some money into work in Home Depot also. And then I showed IBB and XBI, and that's the end of the focus list. So as always, like to hear from you with feedback. The email is don@revereasset.com, or you can call 855-REAL-WEALTH. That's 855-732-5932. So wrapping up Tuesday, big eventful day, a little bit for everything in there, a little bit for bulls, a little bit for bears, a little bit for agnostics. Just remember, it's not how much you make in the market, it's how much of that you can keep. Don't like seeing our stops triggered on harsh sell-offs and then the market rebound, but it's part of our loss control. Over the long term, we can outperform the market with less risk when we take advantage of the great times in the market and avoid the unhealthy times in the market. Reach out to us if you want more info on this. So wrapping up Tuesday, November 15th, this is Don Vandenbord telling it like it is. Thanks for listening and have a great day.